The floor is now open, so please feel free to quiz.
Please raise your questions because we just have 10 minutes for the questions.
This question is for Nilesh Bhai. Nilesh Bhai, about the last bit you said on China and the textile industry. Again, perhaps I've been guilty of having those wonderful dreams at times, but suddenly you say that it's rules and regulations and and then there is this system which does whatever, it demolishes cities without a whimper. And here we have a country, I don't know whether we have to be more thankful for being in this independent country where we can put our view forward and everyone has a voice, or we look at China and say, so this is again a debate which I've not been able to settle. But how do you go to, because there they can do whatever they can, and here you can't even pass a GST law, forget about innumerable smaller things. So again, maybe a question with no answer, maybe a very, very philosophical question, but then how do you really tackle such an issue?
So it's not that China is the only model for creating growth. Absolutely, they've done a fantastic job. No country in the world has seen so many people lifted from poverty like what China has achieved. But in one part of India, we have seen what we can do comparable to China, and that's the state of Gujarat. Over last 15 years, Gujarat has delivered growth rate which are better than China. Obviously, China has a bigger base rate. Gujarat had a smaller base rate, but 15 years is 15 years. China had the advantage of undervalued currencies in the early 90s. They depreciated their currency by so much to gain export share. Gujarat didn't have that benefit. Chinese pollution is fairly high compared to Gujarat. Most of the Chinese river water is not worth drinking. We always see in Beijing and Shanghai the kind of pollution they have. Fortunately for us, that's not the case in Gujarat. So Gujarat has not been as lenient towards pollution as China has been, and China is now correcting, no doubt about it. Gujarat was always a democratic state. China was always an autocratic communist state. China had the advantage of foreign direct investment. It received on an average $60 billion a year. Gujarat never had that advantage. So without the advantage of foreign direct investments, without the advantage of pollution leniency, without the advantage of undervalued currency, within the constraints of democratic country, we ensured that Gujarat growth was higher than Chinese growth for 15 years. Now, if rest of India can be modeled on Gujarat, and it's not that Gujarat has done everything right, there are many wrong things which would have been committed. Maybe the success is not entirely attributable to the government, but also to the people. The success is also attributable that Gujarat leveraged its maritime resources far better, which a state like Punjab or Jammu and Kashmir can never have, and so on and so forth. But the fact is that if rest of India can copy Gujarat, we can create an alternative model to China in terms of growth. Is it doable? My guess is that now there are more and more states which are following Gujarat in terms of growth pattern, though their business model could be different. Now Bihar has been growing, and the growth has essentially come in Bihar because there is a better law and order. 10 years ago, you go to Patna, you won't be allowed to go out of your hotel room after 6 or 7. Today, you can walk out at 12 o'clock in the night, get a pan, and then come back to your hotel room. Your host will not worry about you. So a simple law and order change situation has improved Bihar's potential. In IT, Karnataka, Tamil Nadu, Andhra Pradesh have created wonder. In agriculture, Madhya Pradesh has created wonder. Madhya Pradesh agriculture has grown at 20% plus for last 2 years or 3 years. So we have different parts of India which is delivering growth pattern which is better than China or comparable to China without the advantages of China. Our problem is that we are not running it across India. If we can copy that model which is more homegrown into rest of India, my guess is that we will create an alternative model to China which will be as spectacular and as miraculous as China.
I'm sure there'll be many more people wanting to ask questions here. You have a very, very interesting panel. Yes.
Good evening, all of you. One small question. How prepared are we to fight the export of deflation from China? And what exactly are we doing? Now, it's not restricted only to commodities. I believe it's restricted to several other things. This question I would leave to, or I would put it to anyone from the panel members.
So I am a Gujubai, and other than me, all my cousins are in business. And they were all manufacturers, and now all of them have become traders, or most of them are becoming traders. Some of my cousins don't even know how to speak English, and yet they go to China, they import containers and then distribute in India. Very recently, a cousin of mine who was very happy from June to December because steel prices had corrected, and he makes metal cutting tools which is used for cutting marble, and each mine has different variety, and this machine cutting tools, the metal cutting tools, are actually handmade, and they are all tailored towards a particular mine. So he was very happy because his margins were going up with correction in steel prices. Recently in Bangalore, we had exhibition on stone and cutting tools, and apparently Chinese container came, 3 containers full of machine tools, and when you handmade those tools, obviously you create scrap. So the price at which my cousin was selling the scrap, this new machine tools were available. They took the containers empty back, left all the material which they had bought for exhibition as in the market, and dumped it at the price of the scrap. I mean, obviously my cousin was in pressure because he just could not have competed against them. Now I gave him an advice which I don't know whether he followed or not. I said, if Chinese goods are available at the price of the scrap, might as well buy all the 3 or 4 containers worth of goods, melt it and sell it at the price of scrap. You'll remove the competition out. But this is what is happening in India. I don't think so we are geared to stop deflation from China through fair as well as foul means. Certainly if global commodity prices have come down, we have no option but to accept that and move forward. But if this is how they are going to dump goods through combination of subsidies at their level, certainly as a country we have to stand up. Fortunately, in last 2-3 months, we are seeing fair amount of action from the government, especially on metals, metal products, commodities, some of the chemicals, where anti-dumping duty, protection duty, minimum import prices, all are being enforced. One thing we have seen in currency market, that rupee actually stays ahead of Chinese currency. They depreciate by 1%, will go up by 1.2%. They depreciate by 2%, will go down by 2.2%. So clearly on currency side, we are not giving China any room like any other country. And the government is now becoming proactive, but this is something which will require 24/7 vigil. We can't afford our manufacturers to become traders. I mean, that's going to hurt us. And today, in some parts, government actions are bringing support to the domestic manufacturers, but certainly there are large portions where we still need some action. Our trade deficit with China is now exceeding $50 billion. One day it will probably exceed our import bill if the trend continues. So we'll have to really be very, very watchful and balance the need for importing goods at lower prices vis-a-vis giving protection to our local economy.
My question is to Jayesh Bhai. Given the current environment in the debt markets, what would you recommend? Where should HNIs be investing in today's scenario?
And only gilt fund to start with. No, I think we are looking at definitely a big change. If unless this is looking at today, and world is very dynamic, right? So you never know, like, you know, when oil was 140, people talk about 200, and when oil was 50, people talk about 20 and 15 and all that. So, but I'm saying, looking today, where we are today, we are very much globalized, and if there are global problems, if oil price shoots up, if Janet Yellen raises rate more than required and all that, there could be some disturbance. But as of today, there is no reason why the rate cuts transmission should not happen. And once we see the liquidity coming in, people are a little bit still skeptical about whether RBI will walk the talk or not, but I am quite confident that having made a policy statement, they will walk the talk. And if that happens, we are definitely looking at a dramatic change. And again, if you look at the whole bond positioning, bond pricing getting changed, the best way to is to go through mutual fund, maybe gilt mutual fund, and that's the way I would put it across.
I have one more question for Nilesh Bhai. We have FCNR maturities coming up this year. How would you see that impacting debt equity markets?
So one, what is known generally does not create too much of pain. The RBI in the forwards have covered some of the positions. The government alluded to this fact in its credit policy. Market more or less knows that in September 2060 we have to repay $30 billion with interest. So what is known is unlikely to create a bigger pain. Of course, if we go to the Gulf market and tell our brothers and sisters over there that look what happened in Yemen, Lebanon, Syria. I mean, do you want to keep your money in such unstable part? Why don't you bring it into India and we'll give you good, nice rate of return? The world is at negative interest rates. We are still at plus 2, 3, 4% dollar return. My guess is that we will end up getting more money than what we have to pay back. And we should focus on that kind of capital which kind of stays in our country for a longer period of time. My guess as of today is that both the market participants and the regulator knows this event, they have adequately prepared for it, and they might see a surprise because some of this might get rolled over. Everything won't be repatriated back.
So on this very optimistic note, let me thank my panelists, Mr. Nilesh Shah, Mr. Abhishek Goenka, Mr. Jayesh Mehta, and Mr. Jitendra Jain. Thank you very much.
I have one more question, I think. We'll take the last one.
My name is Rishi Jain, and I'm a guest of JJ. And I think I'm the only one here who is not a finance professional but a technology professional. And I've been with Infosys for 20 years. And right now currently I'm in the US, and so I'm also very close to what is happening in the US, and also I follow a lot of global events. So first of all, I think this is absolutely wonderful quality of discussions and the ideas and points and the way it is articulated. I have a point for you, Mr. Nilesh. And I think you made a very good point that your idea of independent India or free India is that 50% should be owned by Indians. So I think that's a fair point. But at the same time, what we consume in India, I think if we are spending 100 rupees, I think 80 rupees is actually we are spending for global companies. So why can't we think of an idea where we actually spend 51 rupees on Indian, manufactured stuff? And half of the problem of your, Gujarat example that you gave might be solved through that as well.
We are lucky to have Baba Ramdev.
Yeah, and he has done a great job. I think he has given multinationals done for their money. So I think for a free India, for a great India, I believe that also is very important. I personally feel that, though I don't live in India, but I feel for India, and I think that is very important.
So the world is fairly complex. There's no right answer or wrong answer. Hindustan Lever has done as much good to this country as, let's say, Patanjali. They have produced some of the finest managers. They have helped creating environment which is good. They have created products which we all as consumer have enjoyed. So I'm not against foreign direct investment or foreign portfolio investment. I mean, their money and our money is the same. But the point is that if the economic ownership is not with us, maybe some of the decisions which will be taken in future could be detrimental to us. And a case in point is that in multinational companies, we liberalized royalty payments somewhere about 5 years ago. Earlier, they were all restricted in terms of how much money you can pay to your parent. Then we liberalized in line with the global market. And in last 5 years, royalty payments have grown at a faster pace than their profit growth. More importantly, all these multinational companies' profit margin are lower than their comparable domestic peers. So if you are telling me that this mother brand is so good globally, at least let it make more money and more margin than a domestic guy. You can't be charging me royalty as a minority Indian shareholder against a brand which is not able to compete with my domestic brand. So we need to be safeguarding ourselves. We have great examples of foreign-owned companies doing good job in India. But at the end of the day, from our selfish point of view, we need to retain economic ownership in our country.
No, I completely agree with you. I was actually concurring with you. And I think I was just adding that if we think of also consuming, products which is manufactured in India, I think that will be great service for the country. That's all I was trying to say.